Okay, so today we're doing a deep dive into something pretty fundamental to the whole AI boom. We're looking at the actual financial reality behind those huge AI data centers. We've got some analysis here from Harris Kupperman, a hedge fund founder.
Yeah, the idea is to figure out why this infrastructure, the very bedrock of AI, might actually be, well, financially shaky. Everyone calls these data centers the shovels in the AI gold rush,
Mm.
the safe bet.
Right, the picks and shovels play.
Exactly. But this analysis suggests maybe these shovels aren't so solid. They might be dissolving faster than we thought.
It's interesting. I always sort of pictured them like long-term assets, almost like real estate for data.
That's the common perception.
But realizing how fast this stuff might become worthless,
Yeah,
that changes the game completely. It points to this rapid obsolescence.
that really is the core issue. Let's call it the depreciation dilemma. See, initially, when people modeled these huge centers, they used a standard kind of default depreciation timeline, like 10 years.
Okay, 10 years. That sounds standard for big equipment, maybe. It spreads the cost out nicely on the books.
It does, makes the upfront hit look smaller each year. But Kupperman's research, talking to people actually in the industry,
Yeah. What did they say?
they said forget 10 years. For the really crucial bits, the GPUs, the processors, the specialized cooling, it's more like 3 to maybe 5 years,
Mm,
often closer to 3.
3 years. Why so fast?
Well, two big things. One, the tech itself just moves incredibly quickly. Today's top chip is tomorrow's second best. And two, these places run hot, really hot. They're under constant heavy stress 24/7. It just wears the components out,
So it's like running a super high-end gaming PC, but massively scaled up and never turning it off.
pretty much. And that drastically speeds up when you need to replace everything. Your capital expenditure, your CapEx cycle gets way shorter.
Okay, so instead of a manageable cost spread over a decade, you've got this massive reinvestment needed every 3 years or so. That sounds expensive.
Extremely. And that brings us to the other side of the coin, the revenue needed to cover those costs. This is where you see the revenue chasm.
Chasm sounds dramatic. How big are we talking?
Okay, so according to the analysis, just to break even in 2025, and this is assuming a pretty generous 25% gross margin,
Okay.
AI data centers would need about $160 billion in annual revenue.
160 billion, just to break even. Wait, what's the actual total revenue for the AI industry right now?
It's estimated around $20 billion.
20. So need 160, have 20. That's
Yeah,
a $140 billion gap.
that's the gap. It tells you pretty much anyone providing this kind of general AI compute is likely losing a lot of money right now.
But what about scale? Doesn't building more centers bring costs down? Economies of scale?
That's the common argument, yeah. But the analysis argues if your basic unit economics are bad, if each server rack costs you more to run than it brings in, then scaling just makes you lose money faster.
Right. It's like magnified bleeding, as the source puts it.
Exactly. And it gets worse. If you factor in the CapEx needed for new centers to meet projected demand,
Uh-oh.
the break-even number could jump to maybe $320 billion, even $480 billion a year just to stop burning cash. We could be talking like $1 trillion needed over 2 years just to tread water and grow. Insiders apparently admit these models are incredibly hard to predict reliably.
Okay, this is staggering. So let's connect this back for people listening. Why does a data center's potentially shaky financial situation matter to, say, the broader economy?
Well, it creates huge risk. You can see AI startups failing because the compute costs are unsustainable, massive investor losses, billions have been poured into this. But maybe the biggest thing is centralization. If running this foundational infrastructure means taking huge losses every few years,
Then only the biggest players can afford it.
precisely, only the tech giants with deep pockets from other businesses, like your Microsofts, your Amazons, your Googles, they can absorb the losses. That risks concentrating the future of AI development in just a few hands.
That really raises the stakes. Okay, so for listeners wanting to track this, what are the key red flags? What should we be watching?
I'd say three main things. First, keep an eye on those CapEx numbers companies are reporting versus their actual AI earnings, not just hyper projections. See if the gap closes.
Okay, CapEx versus real earnings. Got it.
Second, watch the bankruptcy rates,
Hmm.
specifically among companies that only do data centers, the pure play operators.
Yeah.
Are they struggling?
Makes sense. And third,
Demand transparency. Push for clearer breakdowns of infrastructure costs from the big cloud providers. It's often buried right now.
right. So wrapping this up then, the AI resolution is incredible, futuristic, but its financial legs might be built on some pretty shaky ground. This whole sector seems reliant on a financial model that, frankly, doesn't seem proven to work on its own yet.
Yeah, it requires constant, massive injections of cash. So the big question becomes, if these hidden factories powering AI are fundamentally unprofitable right now, what happens when things get tough? Who pays to keep the lights on? Especially if there's some kind of market correction or, need for a massive upgrade, does the public end up footing the bill indirectly?
A provocative thought indeed. Who ultimately pays for the infrastructure if the market itself can't sustain it? Something to definitely keep thinking about.